Welcome to the Robcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Hello everyone, and welcome to another episode of our quarterly Mastermind episodes. So if you are new to our quarterly Mastermind, the structure is that myself, Manish, Kataria, and Adam Lawrence each pick a investment or financial asset to invest in, normally that's on the public markets or that's fairly easy or passive for everyone at home to do. I should also say this is in no way investment advice. It's just a bit of fun. But what we do is we each pick one of our investment choices. We explain the reasons why we think it's good, and then we open it up to the floor to the others to critique. So, Manish, Adam, welcome. We're coming to the end of the year. We're recording this on the 17th of December. We should probably start by kind of having a quick chat about what's going on in the market. So, Manish, do you want to get us started?
Yeah, sure. Hi, everyone. It's been another strong year actually in the equity markets. So we've had two strong consecutive years, which is great. And it's kind of founded on some sort of solid fundamentals. So the economy is resilient, right? So no one really expected starting this year, with interest rates having increased for the best part of 18 months to quite significant levels in recent history. Despite that, the global economy remains resilient, and the US economy, which is the largest part, is really solid. Unemployment is at kind of record lows, almost at record lows. Inflation, they seem to have done a good job on inflation. That's kind of been nipped in the bud for now, so that's good. We're in a rate cutting cycle, which is always positive for equity markets, right? So all of these things combine together to give us 20% plus gains again for this year. And then you've got the added bonus of, AI, which is not really a bonus. It's a really sort of important thing, which is having an impact on earnings growth. Then you've got, Trump, and that's added a bit of fuel to the fire to the equity markets. And ultimately, if you look at earnings growth, they're accelerating. Q4, which we're in right now, we've just seen an accelerated earnings growth, which is why we buy stocks, right? We buy stocks not for the stock prices. We buy stocks because we are buying future earnings growth. So it's all sort of perfectly aligned, and it's all come together really well, this year as it was starting to last year.
Yeah, and it's interesting, isn't it? Because people often get confused by the economy and the stock market, and obviously they're very different, and and also negatively correlated by the looks of how things have performed in the past on the whole. Having said that, so when you just mentioned interest rate cutting cycles are good for equity markets, that's quite an interesting sign, isn't it? Because they're normally cut when the economy maybe needs a bit of a helping hand.
Yeah.
So yeah,
it's actually when rates are cut, you're right. That's normally in a recession, but when rates are cut and when the economy is holding up, that's a really powerful combination for equity markets. And just on what you said is a really good point. Economic growth is 2-3%, but actually earnings growth is at 10-12% at the moment. So there is that disconnect. They're not always the same, as you say.
And then when you factor in inflation, there's quite a big real earnings growth as well. I think it was today or yesterday they came out with income, so individual sort of wage growth and things like that, and that's also beating inflation as well. So there are some positive things to look at. Adam, what about you? What are your thoughts on how things are?
Yeah, really do I depart too much from where Manish is, but I'm quite a bit more bearish than he is, to be honest with you. Earnings this morning have surprised as we're recording this on the upside in the UK. We know where we're going to be in April next year as far as minimum wage goes. It's a bit of a redistribution. I wrote a piece about this a few years ago in that post-pandemics, there tends to be a big shift in the advantage of the returns on labour versus the returns on capital, which I think historically had probably been on the back of in a pandemic or a real pandemic, if I dare to use that phrase. Lots and lots and lots of people died who were in the labour force. Whereas what happened during COVID was actually maybe 1% or fewer, and it attacked old people who aren't working anymore quite significantly. So you'd have thought we wouldn't have seen that phenomenon play out, but it has played out because people left the labour force, people are on long-term sickness. It messed with a lot of the checks and balances on the benefits side of the economy in the UK, and that's had some negative consequences. So we had we were expecting sort of 4.5% income growth this morning. We got 5.2, so that keeps rates high. I think Trump, as Manish said, always interesting to see how that plays out, but that probably keeps interest rates higher for longer as well, because some of his policies are likely to be inflationary. Trump's track record is kind of at least having a go at what he said he's going to do, although it doesn't always look like that at the end if you look at things like the wall and all the rest of it. But if there are tariffs involved, they're likely to be inflationary. And the US and the UK are both still struggling with inflation closer to 3% than 2%. So I've started to take this view that the base rate is not coming down a lot below 4% in either of those nations in the near future.
And what do you think that does to equity markets then?
Well, I think they're probably overconfident in thinking we're in a cutting cycle. So this is historically the most fragile part of the cycle, when you've finished hiking and you're kind of over the hill and you think you're on the way down. If you look back historically, there's always the same feeling in the markets. Everyone's quite optimistic, and then suddenly something goes wrong. The unspoken piece is the size of the debt and how much, now we're at sort of 1.2 trillion to service the debt in the US. It's got to a really fairly bonkers level, and it can't keep going on without dragging on performance quite aggressively. So the UK, not that it's in amazing shape, and the UK's got its bigger problems in that the elected government have just killed off all the growth that there was. There were good green shoots of growth the first couple of these this year that we've done, and the weed killer's been doused on them, and we're losing 0.1% a month in the economy. The PMIs yesterday are a little bit more positive than they were, but not the manufacturing. Manufacturing looks terrible, because manufacturing will suffer more from the minimum wage increases next year. Services look a little bit better, maybe okay for December.
So can we differentiate here between the US and I guess global markets, where the US has a big sort of weighting on that, versus the UK? And actually, how does that really affect the markets? Because the UK's got this one market, and we're seeing all this stuff in the news about companies not listing. And I think it was something like 66 companies have delisted from the UK stock market, with only 18 going onto it, which is a real kind of blow. I think the only one that's come on was the company that owns Paddington Bear, because it was so British they just had to. They couldn't possibly go anywhere else. But I mean, how do you think that's affecting the UK kind of stock market, and then how does that in turn affect kind of everyone's lives? Because surely a well-functioning stock market in the UK is a good thing for everyone.
I think the UK is well, the UK is, we have home bias, but actually most of our pension funds are invested in global funds, right? So if you're invested in a global fund, the benchmark UK weighting is only 4 or 5%. So from that point of view, it shouldn't make a huge amount of difference. It's not great for us living in the UK to have our stock market, underperform continuously. But from a sort of investment point of view, from our pension fund point of view, it shouldn't make a huge amount of difference. I think the big difference between the UK and the US is, well, the UK has underperformed, but why is that? Because the US is more dynamic, right? So you've got more tech You've got more AI related sort of, what's happening in the crypto space. It's just a more dynamic economy with a greater weighting to these new economy sectors. Whereas if you look at the UK, it's what is it? Pharmaceuticals, banking, and oil companies and old economy stocks, which aren't really sort of going anywhere right now. So that's the key difference right now, in my view.
Mm.
Yep, I think that's framed it well again. I mean, obviously, from a UK perspective, from a single investor perspective, investing in the US, you'd also expect the currency to improve in favour of the States over the coming years versus sterling, as well as the way things are set up to play out. And a Trump presidency probably means relatively strong dollar, you would think. So there's probably greater returns. And if you run a pension fund or whatever, ultimately your job is to get the best returns you can for your investors. So if you've got to invest offshore, you absolutely do. But the UK stands alone as a lack of patriotic investment, or whatever you want to call it. I mean, Jeremy Hunt had a go at this, didn't he, with the ISA rules, and he was trying to get people to invest in UK companies. Something more probably needs to be mandated, because the trouble is you get to this sort of the cart and the horse argument of, well, no one's investing, so there's not enough money in order to capitalize, particularly SMEs and listed SMEs, right? And then, but if they're not worth investing in, if they're worth investing in, the money would come. And it's sort of like, who's right, and how do you kind of nudge things along? Because Australia are way, way better at this than we are. But every developed nation is better at this than we are. And we're at these horrific lows in that department, really.
It's interesting, isn't it? Because I put a post out earlier this week about the carried interest rules changing for private
Yes.
equity.
So,
And it's a real kind of it's a bit of a difficult thing to get your head round there. But one of the things that I kind of go back to is what private equity is good for the UK is it's good for those SME businesses that want to then grow and exit because they provide the buyers for it. And it's kind of almost that one step before going into public markets as well. And I just think transactions are a great thing for any kind of economy. Um, and if you start to take away buyers, it's not a good thing because it reduces motivation to build those businesses. It means there's lower levels of transactions, which causes kind of lower levels of frictional kind of money to flow. Because every time you buy something, if you think about buying a house, you've got to pay the solicitors, you pay an agent. I mean, normally you do a bit of work to the house, things like that. So I think transactions are a really good thing for any kind of market. And I just get a little bit worried about almost like a self-fulfilling prophecy when you start taking away these things. And if it's the UK stock market, people are delisting, less money's flowing in, all that kind of stuff. It's the opposite of what's happened with passive funds, where actually the money has flown in, and I think it's gone from something like 3 trillion in the year 2000 to 12 trillion that flows in kind of into these passive funds. And it's almost like this self-fulfilling prophecy that just keeps things going up. And I'm worried that with the UK, we're doing the opposite. And so it's just reducing everything down. I don't know.
I think that's a good comment. I think it's a little bit like micro strategy and Bitcoin, isn't it? And what this kind of like the virtuous circle. But what happens when you go into the death spiral is it just amplifies volatility, which is already sometimes a little bit much for a lot of people who don't like investing in stocks because of volatility.
Mm-hmm. Okay, well, look, that's interesting points to look at. Let's find out what we're all putting our money towards at the moment and where we are actually investing, because talk is cheap, as they say. So let's work out where we're putting. Are we putting our money where our mouth is? So I should say that I think I speak for everyone here where our picks that we do tend to actually put money in them. Whether it's through our ISAs, whether it's options trading, especially with Manish is quite keen on that. But again, this isn't investment advice. It's a bit of fun. It's what we do. But hopefully we can get you thinking about it. So have we got a volunteer for going first for the first pick this month?
I'll go first.
Yeah. Okay.
Yeah, I'll
Go
go
on,
first.
Manish.
Yeah, okay. So my pick for today is it's an ETF. It's a blockchain related ETF, and it's listed in the US. It's BLOK, and there is a UK version which is DAPP, which I own. So they're very similar. This one I'm in and out of, but at the moment I'm not in at the moment just because I have the UK one. So it's a blockchain tech and infrastructure related ETF. It's very much linked to the fortunes of crypto and Bitcoin and mining, crypto mining, etc. So just to be clear, I'm somewhat of a reluctant investor. I'm a sort of relatively late convert, and I almost sort of own Bitcoin and crypto just because I feel I need to right now. I'm not a passionate investor. But this is, so, and I was saying to you guys yesterday, I think this is one of those ones which is higher risk for me. Normally, I'm a pretty steady Eddie investor. And so this will either melt up or melt down next year. I think it's a good chance, there's a good chance of it continuing to do well. So what does it own? It owns various different companies. So it owns sort of tech companies that supply to crypto related miners. It owns companies that build blockchain related infrastructure. It owns platforms like Coinbase and Robinhood. Also, Adam just mentioned MicroStrategy. It owns MicroStrategy as well, which is almost sees itself like a bank of Bitcoin. So yeah, that's my pick. It's had a good year because it's linked to Bitcoin, so it's up 76% this year. But if I look back over the last 5 years, it's actually just breaking even over the last 5 years. It might even be down a little bit. So that's why I think it's a bit of a punt, and that's why it's a small part of my portfolio. It would never be a core part. It's a small part. And the best thing about this is I sometimes do this using options. So with options, I'm getting 3.8% in 1 month.
Wow.
And so the way you structure this is even if block declines by 10%, all the way down to $48, you're still going to get that 3.8%. So you've got some downside kind of risks managed for you there. So yeah, and that's my pick for this month, for this quarter, I should say.
That's a massive sort of rate that you're getting on a monthly option there. Because typically, I when I think of options, I'm thinking kind of 1% a month is pretty good. So that's very big.
Yeah.
I guess my concern with it is it a bit late to get this? Because it's kind of, like you said, 5 years ago it was at this level and then it kind of went right down. And now it's kind of shot back up with kind of, I'm guessing, with Bitcoin's
Yeah.
kind of rise this year. Um, but I just think, well, what's happened previously when Bitcoin's come down? I mean, I know it owns a lot of these companies, and it's not just in Bitcoin, but it owns these companies like MicroStrategy and various other platforms and things like that. I'm just thinking it's what you're buying it when it's at its top.
Mhm.
Where do you think
Yeah.
the growth is yet to come from? Where do you think? Where do you see that?
Yeah, this is very clearly linked to the fortunes of Bitcoin. So if Bitcoin has a dive next year, this will dive. I'm totally aware of that, and you have to kind of you have to know that for sure. This is very much, it's not going to be sort of detached from what happens to Bitcoin. So then you kind of take a view on Bitcoin and crypto and that whole space, right? And it's been huge this year. I completely agree. But there's a lot of momentum. And then if that, it's broken through 100K, which was a psychological level. A lot of people are seeing this whole space as almost like a sort of like digital gold, right? It's not quite the same, of course, but the more people that think that, the more it will become, right? Again, it's a self-fulfilling prophecy, right?
The
And
way,
then a lot
the
of
way
people
you,
thought,
where you say that is it kind of the more that people think that, i.e., I need some other people to buy this off me at a higher
yeah,
price, and that's kind of is that what
it is,
your
yeah.
philosophy is on this, rather than actually it's creating earnings, which you spoke about before for the future.
Totally. I mean, let's be clear. This thing has no earnings. Bitcoin has no earnings. It's not going to replace the dollar, which a lot of people think. It's not going to do any of that. So this, Bitcoin, I could see a case where you can go up to 1 million per Bitcoin, or it can go down to zero, right? That's the thing. No one really knows in this space that people think they're an expert on crypto, but they're not because it's such a young asset class, has no cash flow, it has no fundamentals, right? So what are we left with? We're left with a potential store of value. If enough people think it's a store of value, it can become a store of value. So, I mean, just think about gold. Gold, okay, has some industrial applications. You can buy jewelry, but for the most part, gold is just a store of value. That's essentially what it is. It's a physical store of value. So Bitcoin is, you can see it as a digital store of value. But look, let's not pretend we know what's going to happen to this because I have no idea. This could go either way. So yeah, it is linked to where Bitcoin is going. Absolutely.
And this,
I'm just playing the momentum in the meantime, right?
sure.
To kind of get the options premium and to play that momentum which exists at the
And how
moment.
long would you expect to stay in this for? And what would need to happen for you to go, right, that's enough for me, I'm out?
Yeah. I think you'd have to have really strict risk controls on this. So with options, you get that inbuilt already. I think if one of the lessons from 2024 is that there were lots of times when I was looking at things and thinking, okay, well, this has gone too far. And by the way, the S&P 500 has had 50 all-time highs in 2024. And it still keeps going up, right? So the fact that something is at an all-time high shouldn't make you feel that that's it, it's done. I think you just have to have tight risk controls. What I would do, and what I always suggest to people, is if you're in something that's really growing strong, at some point you'll have made your capital back. So sell down your capital and let your profits run, because that way you'll never have a loss on your capital. That's one thing you can do. But yeah, look, you've got to have stop losses in place on something like this, I think.
And let's say Bitcoin did go to kind of zero or shot down in price. Are the holdings of this ETF, are there any are there any kind of holdings there that still do all right in that scenario? Have they hedged anything? I mean, like, I guess Coinbase is on transactions rather than how much the cost of Bitcoin is. But obviously, the more Bitcoin goes up, more people are attracted into it. But I mean, what about? I don't really know that much about MicroStrategy and things like that. I mean,
Yeah.
are they earning money, or is it just a case of?
I mean, MicroStrategy has a tech business, but by far, Bitcoin is the biggest factor. I mean, this ETF owns things like Robinhood, which is a sort of trading related platform. It also owns PayPal. So it's not all Bitcoin. Majority is crypto related, but there are a few companies which it owns which make real profits doing transactional sort of profits from transactions on whether it's money transactions or investment transactions outside of crypto. So there's a bit of that.
Mhm. Okay, Adam, any thoughts?
I thought that was fabulous in terms of what it covers and a really good summary of how I feel about crypto and Bitcoin in general, about the inherent value or lack thereof and about what it's used for. And I think there's some really sensible commentary in there about all-time highs and all the rest of it. I looked at something the other day that was saying where the air in the S&P this year has come from in terms of expanding PE multiples and things like that. And it's an interesting conversation because it goes in multiple directions. But there's usually just a justification of why this time it's different. And I'm not a big fan of this time it's different. So the wheels will come off at some point, but it doesn't mean, like Manish said, with some sensible risk controls, you can't take advantage while you're on the way up. So I wasn't sure if it was just a bit of a Christmas punt when Manish told us that he was going to be getting stuck into that. But I think probably the explanation of anyone's that I've enjoyed the most ever since we've been doing this, to be honest. Really, really liked it. So ride the lightning. I would say don't ruin your Christmas Eve by waiting for the Christmas crash that'll inevitably happen when people start manipulating the markets. But Manish also I think it was Manish, put a great post on socials the other day about what sort of percentage of your asset base we should be talking about when we're discussing things like crypto and volatility. And, it's in that 1, 2, 3, 4% range if you're extremely aggressive. So if anyone's listening to this and they've got half their net worth in Bitcoin or whatever, my advice to them would be to chill out for Christmas, realistically. But yeah, it's a fascinating area that I just remain wedded. The trouble is I'm so wedded to property and the utility within property that when I see an asset class that has essentially no utility, I struggle to process why I would want to. And I'm not a natural trader. The idea that it's all right, I can buy that because someone else is going to pay more for it tomorrow. The old castle's in the sky, like you said. It's just not my. It's so far away from my DNA, Rod. I really struggle to get there, to be honest.
I think that's kind of why I was asking the questions about the underlying companies within it, because I think it's quite a good way to expose yourself to Bitcoin if you are a bit of like you said, you struggle with the whole concept of finding a buyer who's going to pay more. Um, because actually it's got underlying companies that are creating value not just from the price of it, but by providing a service, or there is utility within those. So I think it's a clever way of getting into that. And like you say, it's FOMO essentially, isn't it? Because you're like, well, I want a little bit of this. I don't want to miss out on these big gains, but at the same time, I'm acknowledging that look, I may not be a kind of a cult recruit in the firm believer of what it's there to do, because like Manish said, no one knows. It's too early. It's too early days here. So yeah, I think if you're keen to get to dip your toe into some exposure there, and you don't, and I think everyone should have a small fraction in that. I think that is, to be fair, sensible. Then I think it's quite a good way of getting into that market and exposing your portfolio to that. So yeah, right.
Mate, all the dinner parties in New York at the moment, the crypto boys and girls are laughing it up at the one end, and the miserable people like me are at the other end, just looking on, just shaking their heads, tutting occasionally, stuff like that, you know.
That will be you next year, Adam, maybe.
I stand with Warren. That's what my shirt says. I stand with Warren. Sorry, mate. Sorry.
Awesome. Okay. Shall I go next?
Okay.
Yeah. So my pick is Ranmore Global Equity Fund. Now, I do own this, and I was fortunate enough to meet with the fund manager, who's a guy called Sean Pesh, who is a real out and out value guy. He's an absolute kind of diehard value investor. He set up the fund in 2008, and every year it's outperformed the index, apart from the 12 months up to September 2024. And we'll go through kind of how that's happened and why. It's up by around 100% in the last 5 years. It's a small fund of around 400 billion. They invest in decent companies that generate cash, that have good management, and that's kind of their philosophy there. So they're not kind of investing in something that's not making any money, thinking it's going to grow. They're wanting a decent company that makes cash, that's essentially that they feel is underpriced. So Sean, like I said, is super passionate about it, and kind of once you kind of wind him up, he kind of lets go. And some of the things that came out in the conversation I had with him, I kind of was pushing him on value versus growth, and he said, "Look, since 1974, value outperformed growth until you got to the GFC in sort of 2007, 2008, and there were three reasons kind of behind that." Why growth has outperformed since then? You've had quantitative easing, okay, and that's caused value to underperform. Then you've had fast-growing companies like the Magnificent Seven that have grown at the same time that we've had a very low interest rate environment. So that's meant that their growth rates have been discounted at these lower interest rates. And then the third reason is passive investing and the rise of that. And I think, like I said, it's gone from 3 trillion to 12 trillion of inflows of capital in that time. since 2008. So there's a huge amount of money that flows in, and we kind of talked about self-fulfilling prophecies on that, and it all just ends up going into those big companies as well. So that's kind of his reasoning why growth has kind of shot up over that time. Now he's saying that quantitative easing on the whole is now over versus where it was from that 2008 period to now. I know there's still a lot down, but he says on the whole it's come right down. These big companies are so big that it's harder for them to grow their earnings by the same kind of large growth rates that they were doing. So it's difficult for them to continue to outperform. In terms of what the fund has, so it's got very low exposure to the US compared to kind of most kind of indexes, I guess. Very low exposure to IT. It's completely removed from an index. So the reason I like this is I kind of pound cost average into the Vanguard 100% equity fund. That's kind of my go-to thing every month. A bit of money goes
The
into
rock and roll guy, Rod. That's the thing.
exactly
Such a
that,
rock and
yeah.
roll guy.
Hey, look, I did dinner parties too. So that's kind of my big thing. And why I really like this is it's totally removed from any index. And I think a really interesting point on this is when you kind of look at active funds, one of the things to look at is what percentage of the fund is actually active. And quite often you see these funds and it's 70 or 75% is active. So you've got quite a bit that's still passive, but they're charging you these fees. And you think, well, why the hell am I paying these fees for a quarter of it to be passive? So again, this fund is 99% active, which again, I really like. They find value where others don't look. So, for example, we've talked in a few of these episodes about Japan. Certainly, a few years ago, Warren Buffett started releasing that he had invested into Japan. At that time, they were selling their Japan, a lot of their Japan gains, and redeploying it into China. So they are not the kind of fund that will buy something and go, I'm going to buy this company and I'm never going to sell it. They would much rather take the gain, redeploy it somewhere else, and essentially compound that capital. That's what they like. So they're happy to move it around. They're happy with high turnover of companies and different geographies. They trying to go look at what else. So, for example, in China they bought Ping An. It was at 5 times earnings, 8% yield being paid out. It was under the book value. They bought it at 33, and they were selling it out at 80, sort of before the year was up. So that's the kind of thing they'll do, and then they'll look at where things are. So because they're a small fund, they can be quite nimble and they can get into places quite quickly. They do not like speaking to managers of companies, so they have a bit of a catchphrase, which is numbers, not narratives. So they won't go and they will not have any meetings with management. They kind of say, look, most of the times when you meet them, it's actually investor relations that you're meeting anyway. They, however, do listen or read transcripts from various meetings of management and things like that. And what they'll do is they'll look at, right, when this management came in, what was the return on assets? What was market share? And what is it now? So let that be the performance rather than hearing a story behind it. Their holdings at the moment, they've got a lot of banks, a lot of European banks. They've got travel and leisure, a bit of pharma and biotech, some auto as well. They're quite overweight in Japan, in China, in South America, in UK and Europe. They kind of talk about these things. So another example is oil. So they were quite keen on oil. So a year ago, looking back now, they said if you'd asked us a year ago what we thought would happen to the oil price, we would have said it would shoot up way higher than it is now. But because we're not high conviction people, rather than going, right, we're going to do a bet on oil, they actually went for, well, let's find the producer with the lowest cost base who's got a decent balance sheet. And that's what they went and did. And they bought Petrobras, who I think is based in Brazil, and got 40% of their capital back just in dividends within 1 year. So these are kind of the things, the moves that they make. In terms of tech, why they're not that keen, another reason why they're not that keen on it at the moment. So an example they've given is where you've got a lot of stock based compensation for these employees, you see on the P&L or income statements, as they say in America, that it's showing a lot of free cash flow because the company's buying back shares. But actually, what they're really doing is they're just buying back shares that were on these employees' share option agreements. So there's no new shares being made, and they're paying a load of money not out to shareholders, but out to employees to take those shares back. And they're actually saying, well, that's not beneficial for any shareholders apart from actually the employees who then move on. So yeah, I really like this one. They're very kind of open about what they're doing, where they've made mistakes. In 2014, one of their largest holdings was a company called Nvidia. They had no idea it would blow up. They took their winnings. They got a good margin out of it, and they decided to sell. So they're not immune from things. But if you ask if was that a mistake, they said no, because actually there's been plenty of companies where had they held onto it, they wouldn't have had good gains. So yeah, lots of just loads of insights from them. As you said, the future is unforecastable, so let's not pay too much for it.
Yeah.
So yeah, I'll open that up to you guys.
Well, I think I like to. There's a few things I'd love to say about that. Really, one, you had me at hello with the whole investing in solid investments with good management, because that's like Berkshire Hathaway through and through, isn't it? So that's lovely. I think there's probably a chance of a little lesson here, or something that the people listening might not know about, which is what they call the Morningstar 5-star fund effect. So when you've got these smaller funds that are nimble and agile and all the rest of it, the time to look out is when they 10x in size overnight, because they will lose all of those edges. This is the old Warren Buffett, give me $1 million, I'll double it every year, no problem. Unfortunately, he has to manage the thick end of 1 trillion. So it's not possible to get those sort of returns. But all of that fundamentally works if you've got the skills to do what they do. I love the sound of it. I'm just sitting here feeling really boring and disappointed at my pick, because you guys have done so well. So I'm just going to let Manish take over now, to be honest.
I mean, I look, it's a great story, isn't it? I mean, everything you've said, I mean, these guys know what they're doing. So it's a great story. But sometimes, sometimes we hear good stories and we think, okay, well, that sounds really compelling, and let's have some of that. But actually, what really matters are the numbers, right? So that you have to detach the story from the evidence. And if I look at the evidence, you sent across the fund before we had this call, and their numbers speak for themselves, right? Their performance backs up the story. So I like that, right? Because I'm not an inherent fan of value, because I just think value sounds good. Why wouldn't you have low valuations over high valuations, right? I mean, why wouldn't you buy something cheaper? But you can be in a value trap for years and years and years, right? And value traps are all around us. But these guys seem to have unlocked the secrets, right? So they've got a good story, they know what they're doing, and the numbers are great. With the exception of this year, they've underperformed a bit this year, as you mentioned. And that's because they're not in the sort of momentum stocks, which is fine, because that's not what they do. But yeah, it's really hard to fault it, because if the story stacks up, if the numbers look good, I can't really fault it. I think it's definitely something to have in your portfolio as part of a diversified portfolio.
Yeah, I think one of the big negatives when people look at this is kind of the cost, because we all know, like, passive investing, low cost ETFs, things like that. This is not that, so there is a cost of it, and I actually questioned that with Sean, and he just came back and said, look, we're a small company, we're a small fund, it's around 400 million, so there is a cost for us to keep the lights on, but the benefit is we're a speedboat, not a container ship, and we can move quickly into it, and that's what's been working for us. So again on that, you look at what the numbers are after that cost, and it's still very good.
Yeah.
So it's been a good buy for me, if I'm honest. And I sometimes I'll look at that and go, oh, have I had all the juice out of it? I don't think that's the case here. I think it's still in that area where they're very good managers, they're on the ball, and until it gets too big, I think it's a really good. It gives you really good exposure that's just totally uncorrelated to the typical indexes where you've got kind of these growth and the big kind of the big boys taking a massive majority of that index. So that's why I like it, and yeah, so that's where
The only other thing I would add, Rod, is that overall, I mean, this is an active manager, right? And that's why it charges the higher fees. Overall, the active management space, they about 90% of them end up underperforming over the long term. They underperform the index over the long term. So these guys have not got to that point yet. So, they're still outperforming, which is great. But it's just, you might not want to hold it forever because at some point you might expect it to start underperforming, or it might not. I mean, it might be one of those 10% which keeps outperforming.
Yeah, yeah, absolutely. And I mean, look, it's been going since 2008, and it's outperformed there since that period. So, and that's been a time where actually value has not been meant to be outperforming. So I think that's what's really that's why I like it so much. I think, right, okay, well, they're making it work even when the environment
Absolutely.
Yeah,
That's what surprised me actually when I saw the numbers. Yeah.
yeah, brilliant. Okay, Adam, over to you.
Oh, the damn squib of the pack here, I tell you. So I've gone for Wise this month, which is a company that I'm sure a few will have heard of. Specializes effectively in transferring money to different jurisdictions. And I've liked this business for years and years. I've used it a number of times myself. I like the people who back the business to get it off the ground. Richard Branson was involved, apart from anything else, and you'd expect he's got a reasonably good eye for that sort of thing. So I've always admired it from afar, and I think it appeals to my personality type because a lot of the apps that you try and use to move currency from one currency to another, from one jurisdiction to another, the price is always, it depends. It's always a bit opaque, and it can be incredibly high. This is, Western Union charge huge fees on small transactions. That's their business model, Wise are transparent across the board. And if you play around with bigger sums of money, you're going from anything from 0.5% if you're sending a small amount of money up to 0.25% fee. So in the world where, traditionally this world is phoning up a broker to do the transaction for you, there's personal service and all the rest of it. This has crushed that side of it on the internet, like many a business has done. And obviously it's not without rivals, places like xe.com that have been around for a long time are big operators and do a lot of volume in this space. But I just think they've got the cleanest, crispest model. They appear to have competitive advantage. Opacity will win. And I bet you there's some very, very big businesses that move money around using Wise rather than using their bankers that they've been used to using. And I still think they've got plenty of room to grow. So I like the stock quite a lot. I think it could move well next year. I think we've been talking earlier on about why people move money between currencies apart from anything else. And that's probably likely to continue on the increase around the world rather than decrease. So I think it's got a good future. We've not missed the boat. We're not too late to the party, and that's why I've picked it this quarter.
So I like it when I use a company that I find value in it and you can invest in it. So it ticks that box for me. what I'm unsure of is the price at which it is now. So again, a bit like Block, it's around where it was 5 years ago in terms of share price. It's gone down and kind of been pretty stagnant. Um, However, the last quarter, its earnings did beat expectations, and it's kind of the return on equities exploded up kind of to 41% from, I think, the last four-quarter average of 15%. And over the last 10 years, that average was 2% or 2.9%. And I'm just a little bit worried it's shot up on this kind of latest thing. Is this here to stay? And I kind of just want to know a bit more about, well, what have they done over the last quarter that was different to all the ones before, and how will that continue?
And look, that's a great question that I don't know the answer to. And I think what I'm banking on, if you pardon the pun, what I'm banking on is more and more of a need for this as more and more money enters more jurisdictions that are a little bit more minority, I suppose, if you like, because there's still the one thing there still is, certainly from a UK perspective, looking inward, is a want to get money into the UK, aside from anything else, and probably apart from first-time buyers, overseas investment, despite the best efforts of the government to put them off in property, are still one of the only growth areas there are compared to incumbent UK landlords, let's say. So I guess I'm punting on a macro growth position rather than a specific one. But it's the company I like most in the sector and the one that I think has got the competitive advantage that I don't think is fully priced in, I guess, is the answer to the question.
And so how am I right in saying the way it makes money is, so when I need to pay someone abroad, I go on to Wise and it just takes a small fee. And is that the way, or is there other things?
So it will do forwards and things like that as well. So if you've got a mortgage abroad or something, you can use it to fix your payments for however many months or years you might like to. And obviously it will use forward contracts to achieve what you want to achieve on that front. So it can provide some smoothing and things like that. But generally speaking, the primary use is for one-off transactions.
And are they like, because I know they've started doing business bank accounts as well.
That's right.
So they're not. I don't think they're covered by the FCA kind of deposit amounts, but I mean they're clearly branching into new things.
Yeah.
It's interesting to see, like, are they going to make money, or sometimes these new things can create a loss. But I'd be really interested to know what it is in terms of, is it being that they've revenue shot up or costs have reduced, or is it just the case that actually they had one good quarter, and or is it actually this is just the start of a lot of good stuff coming through?
Regulated by the FCA, but not covered by the FSCS. Yeah, absolutely. And I think to an extent there might also be an element of which I'm trying to, miss the Revolut bandwagon. So if they can follow some of that side of things, it might well be worth trying to capture some of that value, because that probably went to a level of valuation that I certainly didn't expect or really understand, to be honest with you. And I'm wondering if they could be the next Revolut in the space if they're going to get that bit right. And I think they've got good management team, good vision in the way they were founded. Maybe they've floundered a bit over the last number of years, or maybe the market just hasn't appreciated what they've been doing to an extent.
I just don't like the idea of going to them because something else was missed on something else, where I'd want to get my head around what it is that has been the catalyst for that. Because I mean, I think their enterprise value has gone up to 8.7 billion from sort of an average of 1.3 billion over the last four quarters. So something's happened that's big, that's massive. And is that just that they've beaten their earnings call? And they must have bloody smashed it out of the park. But I kind of want to know what's causing all that. And is it sustainable, or is it just a flash in the pan kind of one-off? But yeah, it sounds interesting. And every time I've used them, like, my big thing is a bit like why I invested in Google. because I use it all the time, and I'm useless with tech, and it's one of the things that I actually go, do you know what? It's really great. Whereas I'm not a fan of Microsoft and that sort of thing. It's a great company, clearly, but it's a lot easier for me to understand something when I use it, and I do use Wise. So I like the sound of that. Yeah.
Well, I associate Microsoft with annoying things that pop up when I use a PC, whereas like you, I associate Google with improving my life and making it easier.
Yeah, yeah.
Yeah, I
Awesome.
hear you.
Manish, what are your thoughts?
Yeah, I've used it as well. I've always found Wise easy to use, cross-border sort of money movement. So yeah, that's all good. My only what I might worry about with all of these companies, because it's quite a competitive landscape and there's a lot of new things going on. So really the success of these guys will depend on their ability to pivot and move along with, because there's a lot of these fintech companies who are not just moving money, but what they're doing is because it's really hard to move from one emerging market to another. So for example, I have someone I know who works in Asia moving money from, let's say from India to Iran or one of these kind of, that's just an example. It's really hard to move money without paying ridiculous fees. And so what these people are doing is they're using stablecoin as a way to move money across borders. So, if Wise is kind of moving and innovating quite quickly, you have to innovate really quickly with everything that's going on. So if they have the ability to do that, they'll be able to sort of capture that. It's trading at 26 times next year's earnings, which is it's not expensive, but it's not cheap as well. So it's expecting an element of growth in that business. So really, it depends on whether they can deliver and sort of keep up with the innovations in that. That would be the key thing. So if you're comfortable and confident that it can grow at decent levels, double-digit growth levels every year, then I think that it could be a good investment. But that's the key thing. Can it thrive in that competitive landscape?
Hmm. Awesome. Anything else from you there, Adam, based on that what we've said?
I mean, I think you probably raised some fair points. I think the PE bit, it probably just has an element of the discount side of things. And yeah, I think what Manish said about, I mean, obviously it's not a value trap because it's not a value company, but you can often see things with lots of potential. Again, as usual, I always see it as a property analogy, but it's probably quite easy for us to see areas where we think there's going to be significant price growth, but for a number of structural reasons. What's difficult is knowing when that price growth is going to occur. And I can certainly think of a few places where I've thought, oh, I'm sure that's going to do really well. And then it's maybe taken 1, 2, 3 years or even up to a decade to take off. And then eventually it has then taken off. But I take your points around just because it's taken off doesn't mean it's going to keep going. And is it going to crash back to below where it was when it IPO'd? And obviously, I don't know, but I think it's got some upside in it. I think it's not too late to the party.
Brilliant. Guys, that's been fantastic. Thank you very much for coming on and giving us your picks. We're going to cut it off there, but have a fantastic Christmas. Don't lose all your money on Bitcoin. And I hope looking forward to Q1 2025 to see how the results of these, and we'll look back and see actually, I think what will be good is on the next one, we'll look back at the last year and we'll look at what actually the performance of our picks has been through that time. So it's always interesting to go back and see how they've all performed.
Looking forward to that.
Yeah, brilliant. Cheers, guys.
Thanks for having us, Rod.
Cheers, guys.
Thanks. Bye.
Happy New Year.
And to you.